This video will cover the free cash flow model of common stock valuation. I'll introduce and define the concept of free cash flow, and specifically free cash flow to the firm. I'll introduce the concept of asset beta and compare it to equity beta. Equity beta is what we're used to seeing, but in this case we're going to be looking at an asset beta, which is interesting. Then we'll estimate the value of a common stock using the free cash flow model. Okay, the free cash flow model. Now, why are we looking at the free cash flow model? There's two really good reasons. One is this model is extremely insightful. And two, you don't need dividends. So remember, we had the problem, slight problem, that if you're going to apply the dividend discount model, it's probably a good idea that the company pays dividends. It didn't have to be that way, remember, because we said that, well, maybe the company doesn't pay dividends now, but it will in the future. And so maybe 6, 7, 8, 9 years from now, you start paying a dividend. So you basically go way out in time and go out to maybe period 9. Now it starts to pay a $1 dividend when all of the intervening dividends are zero. That's kind of a hassle. This is an alternative model that doesn't require dividends. And it's kind of insightful. So let me show you the insight. And we can't go very far without looking at a balance sheet in this course. And so here we got a balance sheet. And what this free cash flow model is all about is estimating the free cash flow that goes to equity holders. Okay, so it's free cash flow that goes to equity holders. And the free cash flow is generated from the value of the assets. So this is the asset side. That generates cash flow that's used to pay off debt and equity. Now, when we estimated the dividend discount model, we went directly and estimated a stock price per share equal to the dividend per share, because dividends per share are widely known and disclosed in financial statements and so on. And so we estimated the present value of future cash flows, assuming constant growth in dividends, to be this. And it was a direct estimate. We never really thought much about it. Now what we're going to do is we're going to estimate the value of the assets, subtract off the liabilities, come up with equity, which is in the millions or billions. Then we'll divide it by the number of shares outstanding, and we'll get an estimate of the stock price. So the formula will be an estimate of the stock price will equal free cash flow, period 1, divided by K minus G, and we're going to assume constant growth. Constant growth in what? Free cash flow. So keep in mind that this G is growth in dividends, this G is growth in free cash flow. K is the discount rate appropriate to equity, but since we're valuing free cash flow here on the asset side, we need to look at the appropriate discount that reflects the risk of the assets over here. Okay, so we're going to have separate K and a separate G, different than these G's. So we're going to value the whole firm. The value of the whole firm is right here in this block. That's the present value of all these cash flows generated forever. Then what we want to do is we want to subtract off debt from this. So we subtract off this whole block. And then what we're left is this component in millions or billions. And then what we want to do is we want to divide the whole thing by the number of shares outstanding. Outstanding of common stock. And then we end up with a per share basis times 0. There's a lot of similarities you can see, obviously. Similarities are here with respect to the dividend discount model. But you notice there's no D's, there's no dividends in here. So now we got to estimate the free cash flow. The free cash flow is estimated this way. It's the earnings before interest and taxes, adjusted for taxes. So basically what we've left out is interest expense here. And I'll explain that in a second. Plus depreciation, because remember, depreciation doesn't affect cash flow. It's an expense that shows up on the income statement but doesn't affect cash flow. And all this reflects, we're assuming reflects cash flow and here. So we make the adjustment like you learned in accounting for depreciation. And then what we have to subtract off is we have to subtract off CapEx, capital expenditures, and we have to chop off the change in net working capital. So why are we deducting off these CapEx and the change in net working capital? Well, let me show you. Suppose we have an income statement, and then we have cost of goods sold. We have sales, cost of goods sold. This comes up to be gross margin. And then we have operating costs, operating expenses, plus depreciation and amortization. And I'm just going to fold amortization and depreciation. And so we have those costs. And what we end up with is here, EBIT, earnings before interest and taxes, because I haven't deducted off interest or taxes. I haven't deducted off interest because, interest is not buried, is what I want to say, in this operating cost, because it's not a part of operations, it's a part of financing the balance sheet. So what we want to do is we don't want to deduct interest off here yet, but we want to take off the taxes. That's what this says. So it's 1 minus the tax rate here that we're going to multiply this by. And then if you've finished out the rest of the income statement, this would be interest expense, this would be EBT, and then you'd have taxes, and then you'd have net income along the way. So notice this is all reflected on the income statement. It reflects everything but interest expense. We don't want interest expense in this. We don't want to deduct out interest expense in this component because we're looking at the free cash flow generated by assets before there's any deduction for that interest expense, which is a financing area. But now what we want to look at also is, look, CapEx. CapEx does not show up on the income statement. It's capital expenditures. Like you buy a plant for $1 billion. Well, it may have depreciation, which you've already considered, but CapEx, if you buy the plant, it's not showing up here. And the free cash flow that equity holders are eventually going to get after you deduct out this debt, this free cash flow needs to reflect, sustainable growth forever. In order to keep the business growing forever, companies need to invest in capital expenditures. They also need to invest in working capital. And so this is the change from year to year in net working capital. Net working capital is this. You have working capital itself of cash, accounts receivable, and inventory. That's called your asset side of your balance sheet, working capital. Sometimes current assets is a pretty good approximation here. And then you have accruals, and then you have accounts payable. And so the point is here, like I said with CapEx, companies in the long run need to invest in their business. And they need to adjust that cash flow and take into consideration that the free cash flow available to stockholders we have to deduct this CapEx out of there. Because it's not going to stockholders, it's going back into business. The same thing goes with this change in net working capital. In order for a business to operate, the business needs cash, it needs accounts receivable, and it needs inventory. This is money tied up that eventually does not go to equity holders because it's tied up in the business. And so you take this cash flow that's tied up in the business, offset it by accruals in this is accounts payable with a P here. And this is your net working capital. So the word net is you're taking these current assets and subtracting these current liabilities. And then we need to see, how does this change from year to year? So if we got a balance sheet in year 1, then we need to look at a balance sheet in year 2 to see what these numbers are, to figure out this change. Because these are balance sheet items. This is balance sheet that represents cash flow in a period of time. Now, what we need to do is we need to do a couple of things. We need to look at what is K, the discount rate for the free cash flow, and what is the growth rate for free cash flow. Well, in the models we're going to look at, we're just going to assume we have free cash flow growth. So you're going to estimate cash flow growth over time. Think of it through a timeline. This is going to grow. We're going to just assume a growth rate. But what we want to look at right now is K. We want to look at this more closely. K equals the risk-free rate, the opportunity cost of money, plus the beta of assets times the market risk premium. This looks very similar to this K we used here. The K we used here was K equals the risk-free rate plus the beta times the expected return on the market minus the risk-free rate. We just said beta here. This is the beta for equity. We didn't put a little e there. You could put a little e. In fact, we will put a little e there just to differentiate it between the beta of the assets. So we needed, remember when we went right in and valued common equity here, we used dividends. We needed the risk associated with equity directly in there. And so that's why we had the risk of equity. But now what we're doing is we're valuing the business, we're valuing the firm here. First, we're going to value the firm, and the value of the firm is this, right here. Then we'll subtract off the debt, obviously, and then we'll divide by the number of shares. But the point is, we need to value the discount rate associated for this block, the asset block. And that's the asset beta, which is unobservable. You can't find that. And you're going to have a hard time estimating it directly. So this estimate for the beta here for equity, I mean, you can go to any website in finance and get that, or you can estimate it yourself. And that is the estimate is the covariance between the return on stock I and the market divided by the variance of the return of the market. It's just how does the stock's return wiggle with the market's return? That's covariance, because that measures how much risk we have. We'll have a lot more to say about that. It's too early to talk about that in detail. We'll talk about it in a later chapter. But the point is, this is observable. This could be easily calculated. If you got the return on stock I, for Apple stock, the return on the market, and you drop this into an Excel spreadsheet, it'll calculate covariance, it'll calculate the variance of the market, and you have yourself a beta, approximately scaled by 1. So you got 1, here's above average risk, and here's below average risk for the beta. Here we have asset beta, and that is the risk associated with the cash flows here, the return basically that these cash flows generate relative to the return on the market. But with these asset cash flow returns, nobody knows what they are. If you look at Apple stock, well, you can figure out the beta because you can see the return on the stock relative to the market. But what do you think Apple's cash flow returns are doing? It's free cash flow. Well, it's pretty hard to evaluate. So the point is, we need to back into this number. And the way we back into this number is we get the beta for equity, and that equals the beta of the assets of the firm times 1 plus the debt to equity ratio adjusted for the tax effect. Whew. Now let's look at this a little closely. This is observable, so we'll have this number. The debt to equity number is observable. We'll get that right off the balance sheet. We know what the tax rate of the firm will be. So the only thing that's missing is beta A, and that's what we solved for. But what's the intuition behind this formula? Well, we're taking the beta of this assets and we're leveraging it up. This is the effect of leverage that it has on equity. So when a firm is leveraged and it borrows money, then this becomes positive, greater than 0, right? Your debt to equity suddenly becomes greater than 0. And so it's like buying on margin. It's like you buy stock on margin, you become riskier, and that's what's happening here. It's 1 plus the debt to equity ratio is going to drive this equity. So if you had very little equity and almost all debt, so here's your equity, very small, and this is all debt, then you're going to have a really high debt to equity ratio, and that means it's going to translate into a really high beta because your company's risky. It borrowed a lot of money. That should be relatively intuitive. So why is there a 1 minus t here on the debt to equity ratio? Well, the fact that the interest expense on debt is tax deductible, it dampens and reduces your after-tax cash flow compared to equity. So with equity, you would pay dividends out. You don't get any tax deduction for the dividends. But with interest expense, you get a tax deduction. So it dampens cash flow volatility associated with issuing debt. Now, one other thing before we go to an example here. In this K here, this K represents the weighted average cost of capital. It's another way of getting at it. So when we looked at basic financial management and we looked at K for the free cash flow model here, this K was called the weighted average cost of capital, WACC. And it was just a weighted cost of your debt on an after-tax basis and a weighted average cost of your equity, adjusted for how much weight you have in equity. And so it's just another way of calculating K. Okay, now let's do the problem that I promised. Lambert Corporation reported EBIT, earnings before interest and taxes, of $60 million for last year. Depreciation expense totaled $20 million in CapEx, capital expenditures, plus the change in net working capital was $5 million. So I'm lumping it all together in that component. CapEx plus the change in net working capital is $5 million. Free cash flow is expected to grow at a rate of 4.5% for the foreseeable future. Lambert faces a 40% tax rate and has a 0.45 debt-to-equity ratio with $185 million market value now in debt outstanding. Lambert's equity beta is 1.25, and the risk-free rate's 5%, and the market risk premium is estimated to be 6.5%. The firm has 100 million common shares outstanding. What is the value of Lambert's common stock per share? Well, the first thing you want to do here, free cash flow equals EBIT times 1 minus T plus depreciation minus CapEx, capital expenditures, plus the change in net working capital. So now at this point, let's just plug some numbers in. It's 60 million, 1 minus 0.4 plus 20 minus 5, where those two are lumped in there. That turns out to be 51 million. Oh, but let's be careful here. This happens to be free cash flow at time 0 because this was last year's numbers according to the problem. Okay? It was last year's net income, for example, EBIT. So why don't we just grow it by the 4.5% growth rate that goes into infinity? Because be careful here. Listen to the problem. It says free cash flow is expected to grow at a rate of 4.5% for the foreseeable future. That means basically, in our mind, when you do these problems, forever. So therefore, we have free cash flow of 53,295,000. Okay, we know we need this formula. We need to work this formula. We need free cash flow period 1 divided by K minus G, right? Divided by debt, and then, minus debt divided by the number of shares outstanding. So we got one number. We have a second number. Now what we need, we have this debt. This debt is given to us to be, 185 million. Okay, and this is in millions. And then shares outstanding are in millions, and that's 100. Okay, so what we're missing is K. Okay, so, well, we'll figure out K. K, remember, equals the risk-free rate plus the beta of the assets times the market risk premium, right? And this we know it's given, it's 6.5 in the problem. This is given at 5%. That's what we need to solve for. So what is this guy here? What is the asset beta? Well, beta of equity equals the beta of assets 1 plus debt to equity times 1 minus t. This equals 125. We're going to solve for this because that's the unobservable thing. Remember, we couldn't observe this. We can observe the equity beta. And we know that the debt to equity ratio is 45% and the tax rate is 40%. That means the beta for assets equals 0.984. So solve it, and it's one equation, one unknown. It's just under 1, beta of the assets. So that's 0.984. Now we have everything we need to figure out K. And K comes out to be 11.4%. So there it goes in there. So when you work the problem, I'll do it down here. 53,295 divided by this minus 185, and take the whole thing divided by 100 million shares. And that becomes this whole thing right here. This is 772,039,000. And then this is with the minus the 185 gives us 58,739 divided by 100. That's $58.73 per share is the stock price. So it really wasn't that bad. You'll have the formulas at your hand. You'll have this formula at your hand. So assemble what you can. Find out what's missing. Same thing here. I mean, this is ultimately the guy you want to look at. This is ultimately the equation you want to look at. And then look, you got formulas for the whole thing to come through. Just assemble it. It's a bit tedious, but it does make sense. And it does provide you some significant intuition on how to value a firm.